Hello and welcome to Fidelity Connects. I'm Pamela Ritchie. With market concentration and top heaviness a reality, how narrow is the path forward for investors to tread? There is an argument for harvesting beta, certainly, but there's also the presence of powerful stimulus in U.S. markets, from a loosening Fed and benevolent tax policy, both of which can propel equity markets further into the horizon. This propulsion is evident overseas as well as in the U.S., allowing investors the choice to diversify by a region. Joining us for his brilliant take on the beginning of a big, even the biggest week for U.S. and maybe global earnings is Fidelity Head of Global Macro, Jurrien Timmer. Warm welcome to you, Jurrien Timmer. How are you today?
I'm well, and actually, I not to steal the show for a moment, but do you remember 5.5 years ago when we started this show, I had this little guy in the back
Bruno.
as an homage to my daughter, who was basically 6 months out of nursing school at the time and thrust into the whole COVID thing, treating COVID patients in the ICU in Boston. So I always had this. And literally like 5 minutes ago, after we even spoke, I got word from her that she has been accepted into graduate school to become a nurse practitioner, specializing in psychology, which is a very, very good, specialized, and lucrative field, by the way. So she's going to be training to go out of the ICU into a nurse practitioner role, which does a lot of the doctor heavy lifting stuff these days. So I'm very, very proud of her. So just Bruno back there.
Bruno back there has been watching over her. That's incredible. I do remember you saying she was very young and just, but great. She was a body. She was a nurse, and they just took her right into the COVID whirlwind. Wow, how proud you must be, and aren't we grateful to her?
Thank you.
So. We're switching a little bit, but take us through the argument for whether those taking gains, and there are some big names in the market taking gains right now, there's no question, literally household names taking lots of gains. Is that enough to interrupt, this sort of benevolent trace or march forward for a concentrated market?
Yeah, so I think so. What we're seeing, of course, is it's been, a banner year for at least the cap-weighted index, right? The S&P is up 14-15% year to date. The Mag 7 are up 21%. The equal-weighted index is up, 6.5%. So even going down cap, it's been, it's hard to complain about a year like that. And of course, non-US stocks are up, 15, 18, 25%. So it's been a good year. It's not over, of course. And so it's obviously understandable that investors would take some profits. And I think that actually is a good thing, because one of the conversations we have had, for weeks now is the question that is asked of me all the time is this AI thing becoming a bubble? And certainly some of the more speculative momentum plays like SPACs and non-profitable tech and, even like the Bitcoin miners, which have kind of gotten into the hyperscaling business a little bit, they were flying pretty high, right? And some of the PEs, like the PE on the meme stocks, was like almost 300x at a few weeks ago. And that is what got the conversation going about, is this a bubble? Are we going into silly season? And are we going to end this bull market like the one that ended in March of 2000, which of course was not a happy ending? No. And so the fact that the momentum is sort of getting unraveled here a little bit. Bitcoin is at 94,000, and some of these meme stocks and non-profitable tech are down, 10, 20, 30%. For me, actually, not for me personally, but I think that's actually a good thing, because the more we can have these corrections along the way, the less likely it is that it becomes this uninterrupted parabolic move that eventually just implodes on itself. So right. I'd rather take some pain along the way than having it be this unsustainable thing that just collapses and then the market's down 50% or whatever. So as much as it hurts, and it really hasn't hurt the overall market. I mean, the S&P was actually unchanged last week, but it's the fringes of the markets where there was a lot of momentum, and that's kind of getting the air sucked out of it. And so I think all in all, it's not a bad backdrop. I mean, earnings have been very strong. The third quarter earnings season, we can pull up slide 4. Really a very, very strong season. The earnings growth rates started at 7%, ended at 15%. That's an 800 basis points bounce. That is pretty impressive, and certainly much stronger than the average bounce. And so the earnings side is there. The valuations are not really amplifying those earnings anymore, which I think is a good thing. Too much valuation, multiple expression is not sustainable. And so I think, there's a lot going on under the surface. And actually, we can pull up slide 3 real quick just to show you the non-profitable tech stocks. And there you can see, right? So it went from 255 to 200 to 201. That's a meaningful correction, but that comes after a more than double. And so I'm not, I look at this and the big picture, and I say, okay, that's all right. They probably shouldn't have run that much in the first place.
But when you take a look at that question of sort of losing a little bit of the momentum, I guess there's no reason to think that some of those household names that we sort of talked at the beginning, big names taking gains. I mean, there's no reason to think that they won't use some of these moments where there wobbles to go back into some of those. Is that, is that reasonable?
Yeah, I think it is. I mean, it's been a pretty monumental year. I mean, remember, we had a 21% decline in March and April with the tariff tantrum, and here we are still up, double digits. I mean, it's been kind of one of those roller coaster years, which in a way we kind of predicted, right? Because 2025 was sort of promising to be a very tail-oriented year, right? Markets lurching from left tail to right tail, back to left, back to right. And so, you can't blame anyone for taking some chips off the table, especially among this bubble talk. And I think I think it's actually a good thing, because you don't want people just piling in, and then you get to that final parabolic blow off, and that really never ends well. It never has, never will. So this, I think, is much better. But to your point, if we go to slide 1 for a second, the big leaders, the Mag 7, the hyperscalers, they're leveling off right now. You can see that in the upper right side, but that's been after a monstrous run, right? They're up fourfold since the bull market began in 2022. And so this is not a bad thing that they kind of sit there for a while we all sort of figure out what this AI thing, I mean, we know what it's about, but, how much is too much in terms of capital spending? What's the ROI going to be on all of that infrastructure, the trillions of dollars that are being spent? Will investors ever see those returns? And what is going to be the killer app that eventually, hopefully, lets the economy reach escape velocity to have this productivity-led boom that hopefully allows the U.S. and other parts of the world to outgrow this huge debt burden that we have, all over the world. So that's my sense. But I get the question a lot about, are we sort of in the final throes of the internet bubble, and are we going to end up the same way? And I think the answer is at least no, but maybe not yet. Yeah. And one of the things I want to show is slide 10, which is a chart I just created that shows the 5-year rate of change on earnings in the blue, and the 5-year change in the PE in the pink. Like, and you can see back in 98, 99, 2000 that earnings growth was falling, it wasn't declining, but it was decelerating, right, at the same time that the PE was really starting to dominate. And we haven't seen that, right? Earnings growth is very much accelerating still. It's at the same level, actually, as it was in 1998. But the PE is not, you would need to see the earnings side get replaced by the PE side, and we're not there yet. So I do think that we have time for this thing to run some more.
I mean, so the valuation, according to that, is not really the story. The valuation is not taking
Valuation is not yet a problem. I mean, the Mag 7 are trading at 35 times earnings, which is not cheap, but it's not crazy. I mean, I don't have the chart this week, but I had a chart last week that showed that back in 2000, right, or 98 to 2000, which I think is kind of the parallel that fits. And actually, we can pull up slide 7 to show that it does look similar. Like the 98 low, which was long-term capital, was a very high momentum recovery, further accentuated by 3 rate cuts by Alan Greenspan at the time. The current cycle, the tariff tantrum in April, the very high momentum recovery since then. Powell has cut twice already, maybe a third time. So very similar, with the caveat that, of course, history it never repeats that closely. Right. But if you go back then in 98, so if Cisco was the poster child of the dot-com bubble, and NVIDIA is currently the poster child of the AI boom, back then NVIDIA was trading in 98 at a PE of 50, and it went to a PE of 215 at the top. Wow. NVIDIA is at 35 to 50 PE today, depending on whether you use trailing or forward earnings. And so we are nowhere close valuation-wise to kind of the crazy season we saw back in 2000. Doesn't mean we're not going to get there, but at this point, the earnings really are justifying most of the gains for the companies that have earnings. Again, you go to the non-profitable tech, which I showed earlier, that's a different story, but those are generally sideshows, and those will get the air taken out of them from time to time, and it's really not the worst thing in the world. I mean, no, if people want to trade those stocks, that's fine, but those kinds of names should never be the backbone of an investment portfolio.
Hello, investors. We'll be back to the show in just a moment. I wanted to share that here at Fidelity, we value your opinion. Please take a few minutes to help us shape the future of Fidelity Connect's podcasts. Complete our listener survey by visiting fidelity.ca/survey, and you could win one of our branded tumblers. Periodic draws ending by March 30th, 2026. And don't forget to listen to Fidelity Connects, The Upside, and French Dialogue Fidelity podcasts, available on Apple, Spotify, YouTube, or wherever else you get your podcasts. Now back to today's show. Sure.
And I mean, we were saying, perhaps the biggest earnings story is this week. You mentioned NVIDIA. That's what's coming out. There's this question of whether earnings get punished and if they then lead to, the ripple effects that come from that. It's also maybe just a headline to trade volatility. I'm kind of wondering how you put that in context.
Yeah. So it is certainly true that the market is priced for success, right? And we can pull up slide 9, which is a new study that I did, instigated by the great David Wolf, who I call the Wolfman. And he asked the question, and I did the study. But so when you look at a discounted cash flow model, right, you have and you look at what earnings growth is expected by looking at Wall Street estimates. Currently, the market is expecting 11% earnings growth for the next, let's say 3 to 5 years. And the historical average is 7. So it's expecting more than average, but that's probably part of the AI boom. It could be part of the one big beautiful bill, what have you. But for the market to be priced correctly for that 11%, it requires a risk premium, which is essentially the spread, the premium that investors get over and above the risk-free asset or the safe asset to get the equity return. You need about a 3.8% ERP for that, which it's not the lowest ever, but it is well below average. The average is 5% historically. So investors historically have gotten 500 basis points over and above the risk-free asset by investing in equities. So if you were to normalize the risk premium to what historically has been the average, basically what that means is the market is priced for 18% earnings growth, even though the expectation is 11. So that's kind of where the risk is, that the market is priced for success, right? It's expecting 11%, but it's priced for 18. Again, not the end of the world. It's not a reason to sell necessarily, but that if you want to have an example of is too much priced in, that would be the example. But you compare that to the late 90s on the left, and that was even a bigger extreme. So there, at that point in March of 2000, at the top, you look at the old earnings estimates, and what was expected was 17% earnings growth instead of today's 11. But the market was priced for 25% earnings growth. Now, again, historically, you get 7%, right? So this is at the top, the market was priced for 25% growth. And of course, we know what happened. The market imploded, and we did not get 25%. We got negative growth. And it's just a clever way, I think, of showing what is the margin of, like what needs to happen for this market to not fall down. And back then, that was an impossibly high hurdle to clear. I wouldn't say the hurdle is impossibly high today, but it is. The market is priced for success, and there's no question around that.
You talk about in a recent report the two different tails, and you're taking a look. So this is the AI, the earnings, the discussion of where that all fits and whether it's overpriced. The other is really the monetary policy, and you have so-called benevolent Fed cutting and so on. In Canada, which isn't necessarily something you would be following this morning, but we had a whole bunch of rate cuts early on, then just sort of holding. And lo and behold, we've got one print of CPI coming with, higher than expected inflation, still in the zone, but the discussion of inflation lurking and what that ultimately, does to policy going forward. There's more discussion about the Fed cutting again. I mean, it's really a ball in the air. At one point on Friday, I think it was 50-50. Tell us a little bit about the inflation story as you see it, and obviously the reaction from monetary policy to that.
Yeah. Well, yeah, and I think the story goes farther than that even. So the inflation story, of course, is very important. The Fed has a dual mandate, right? So price stability at 2% and full employment. The CPI, the core CPI, the core PCE, they're all at around 2.8 to 3%. So it's not the end of the world, right? The stock market is not bothered by 3% inflation. And even the bond market, which is at 4.13% right now, even at 3% inflation, investors are getting, about 110 basis points over the inflation rate. So it's not the highest ever, but it's certainly better than nothing or a negative spread. So the market is not way mispriced if inflation stays at 3, if 3 becomes the new 2. But then it becomes a question of the balance between the mandates. And clearly the jobs data, they're not contracting, but they've been softer than I think most people expected. You had that big benchmark revision. Clearly this has gotten the attention of the Fed. And I think that was the motivation for the Fed to cut rates twice over the last few months. But if inflation doesn't go any lower than 3%, it does put a floor on how much the Fed can lower rates, right? And so if the jobs market stays okay, and our internal data suggests that yes, it's soft, but it's not falling off a cliff by any means, then you could argue that the Fed can't really go much further, right? The Fed's at 3 7/8. If neutral is inflation plus, let's say, 100 basis points, which will be R star, then you're at 4 and the Fed is at 3 7/8. That means the Fed is at neutral. But it's interesting because the Fed is getting a little bit more bifurcated, right? You have the new wing, kind of like the Trump wing of the Fed. So Stephen Moran and of the various folks on the Fed that are lobbying for the job of the Fed chair. They all want lower rates because that's what the president wants. And you're starting to get more vocal voices via speeches and papers and things like that about, we're about as low as we can go because inflation has not been defeated. And as Powell gets towards the end of his term, which is not for another 6 months, my guess is you're going to get more and more vocal it's not really dissent, but it's people are going to be more vocal about where they think it's going to be. And we may very well end up with a Fed that is not like the Powell Fed or the Greenspan Fed or the Bernanke Fed, where it was really the chair of the Fed setting the tone, made the decision, and then the rest of the board would go along, and once in a while you have a dissent like we have with Moran now. But it might be really a more democratic Fed where you're going to have votes that are like, 8-6 or something like that. And, that could be problematic because the Fed would no longer be executing policy with a single mindset. But in a way, it's also good because why should one person be able to decide,
Yeah, I mean,
the world, right?
It was always that question of, it really comes down to one, to sort of how one person, which in hindsight, it probably isn't very democratic. I mean, it's just interesting. As things shift and change, you start to see some of the things that were assumptions for a long time.
Yeah.
Yeah, it's interesting.
I mean, in the past, this happened under Greenspan. Like he was the maestro. He really ran a tight ship. And if you were going to dissent against what he wanted, like you could, but you better had a really good reason. And I think maybe in the new Fed, that will be less so, that people will feel more emboldened to voice their opinion. And it will be kind of like the Supreme Court, where you rarely have a unanimous decision. And so, it's probably not the worst thing in the world, but it is something to consider, and especially when you think about the term premium on bonds and what's priced in terms of the forward rate and what that means for other assets. I mean, so that it might create a little bit more of a risk premium for assets everywhere if you don't have quite that monolithic voice anymore.
So interesting. Back to the discussion of momentum and just, maybe slowing momentum in certain areas. Particularly, there's a question rolling in here. What are your thoughts on Bitcoin, the broader crypto space, given the volatility? Does it fit in with, it's not so bad if it comes down a little and maybe avoids a big slide or something along those lines? Does it fit with that story?
Yeah. So let's go to slide 11. And so 11 is kind of the leaderboard, like the chessboard, right? And these are annual 3-month returns taken at 3-month intervals. And you see gold, Japan, EM, commodities, Mag 7, hedge funds, China, all at the top. And when you think about it, at the beginning of the year, that's kind of what we suspected would be at the top, right? It's like non-U.S. equities are finally have their moment in the sun, and I think that will continue. But you see, Bitcoin is now at the top, gold is at the top. Bitcoin's at the bottom, gold is at the top. That is a very unusual place. Yeah, very unusual. So if we go to the next slide, I have a couple of new charts here. One shows various price momentum curves, and again, you see momentum for gold is very strong and actually still rising, even though gold has had a correction as well.
It has, yeah.
And Bitcoin is at the bottom there. And if we look at the same thing, but now on slide 13, by looking at Sharpe ratios, right? So Sharpe ratios is the 52-week return divided by the 52-week volatility or standard deviation of returns. Again, you see the gold is performing very strongly on a risk-adjusted return basis, and Bitcoin very poorly. So answering the question, if we go to slide 16, you see kind of a close-up of gold. So again, in the bottom, I show the last two charts I showed were momentum curves and Sharpe ratio. So the bottom panel here shows the same thing. So the momentum curve is the pink line. The Sharpe ratio is the orange line. This is for gold. And you can see that gold is kind of at a level where
it's interesting.
You can argue it is like over-earned, if you will, right? So if you think about harvesting crops after a lean year or an abundant year, this has been abundant. So maybe gold is over-earning. And then if we go to slide 18, you see for Bitcoin, it's the polar opposite. So Bitcoin is under-earning. And so I do think that there's a mean reversion there coming. I thought that was going to come 2 weeks ago. It hasn't. So Bitcoin clearly is caught up in this momentum flush, if you will. But if you look at slide 19, which is Bitcoin's price against the power law curve of its network, which is the blue,
Okay.
it's still
In
on there,
line,
right?
yeah.
It's not failing, but what you can see is that the new highs are less explosive now than they
Right.
were. And that, I think that's normal. It's a good thing because Bitcoin has grown up. And so therefore the moons are not going to be as big as the early days. And that's what you want to see. Like it in a mature asset class or a maturing asset class, as that blue curve starts to get a little flatter as you get further along the adoption curve. This is what you would expect to see, and is what you should see. And so the highs are less high, the lows are hopefully less lows. I don't think we're going to have like an 80% drawdown, but we're already at 25 plus. But we'll see where it goes. But if we get down into maybe the 80s or so, for me, that's going to be a good reentry point.
That's really interesting. But yeah, in terms of the floor, it's still high when you consider how quickly it's gone. It's massive. A couple of other questions here. You mentioned, diversifying, or the best diversifier might be the global story and the opportunities therein. What are your thoughts on EM? EM, particularly debt, actually, it's been quite a journey for it this year as well. But as we know, EM is sort of intrinsically perhaps a little bit less stable.
Yeah, so if we look at slide 14, so my favorite has been non-US developed, so EFA.
Right.
Not that I don't like EM, but EFA's success story right now, mostly Japan, but also Europe, is that companies there have unlocked shareholder value by buying back more shares, by shuttering, unprofitable divisions, et cetera. So the payout, right, the share of earnings return to investors in one way or the other has really risen quite a bit and has become very competitive with the US, even on a cap-weighted basis in the US. And so that, to me, has been a very powerful success story. EM, by definition, doesn't have that because these companies are emerging. They don't really have the wherewithal to buy back shares. They tend to be more dilutive, so they don't have that same dynamic. But right now, you can see the earnings growth estimates in EM and the rest of the world are rising very fast and faster than in the US. And if you look at the bottom panel, which is the excess return year over year, it is now the highest since 2007. It's not even on the chart. So you're getting some real good momentum here. And what I was mentioning earlier about diversifying, we can go to slide 15. To me, international stocks are really a good barbell against concentration risk in the US. And we know the concentration risk, right? Top 10 stocks are more than 40% of the market. Half of the S&P is somehow tied to the AI trade. And, and it's great if everything comes to fruition the way we want it to. But there's a lot of eggs in that basket in the US. So how do you diversify while still being exposed to equity beta? And for me, the answer is non-US. And it can be EFA, can be EM, can be both. But if you look at this chart, the pink line and the blue line underneath the MSCI EFA index, the blue line is the relative performance against the cap-weighted S&P, and you can see that it's been hard for non-US markets to keep up because of the Mag 7. But on an equal-weighted basis, the pink line, the non-US markets have been very competitive. So from my perspective, we want to have obviously Mag 7 or cap-weighted S&P because that's been a very strong bull market, and until that changes, I think you want to harvest those crops while they're abundant. But to me, ex-US stocks, if that concentration risk ever goes from being an asset to a liability, this pink line suggests that non-US stocks would do very, very well. Maybe not in absolute terms, but certainly in relative terms. So to me, in a 60-40, that 60, I would put in a barbell of US and non-US. And again, it could be EM, EFA, or both.
And Canada fits into that side of things. Yeah, that's interesting that we're getting put into that. It's been quite a year here too. Just on that discussion, would you go so far as to say that the U.S. equity markets are acting in a way that is in a different cycle to the rest of the world? A different part of the cycle?
I think the cycle is the same. I mean, the bull market started everywhere in the fall of 2022. So it's more of a question of beta and alpha and absolute and relative.
Okay.
It's just, the US has been so amplified by the Mag 7 that if you take the equal weighted index, since 2022, the performance has been good, but it hasn't been like 100%, right? In terms of the direction, I think we're all in the same cycle. I mean, we're getting the fiscal push maybe later in rest of the world than in the US, but even there, the timing is similar, like one big beautiful bill versus what Canada is doing and what Germany, for instance, is doing. It's just it just comes down to magnitude,
Okay.
and the Mag 7 has greatly magnified, the returns in the US.
Well, we are delighted that you shared your time with us, and we'll join up with you from Europe when you're doing some family time next week. We'll look forward to that. Thanks for setting us up for this week, Jurrien Timmer. All the best.
Thank you very much. Have a great week, everyone.
Thanks for watching or listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. While on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on YouTube, LinkedIn, and Instagram. We'll end today's show with a short disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or securities cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks again. We'll see you next time.